Many people are not ready for the crash that is coming in gold and silver. Why? Because they lack historical context. A lot of people thinking that the prices of gold and silver will continue to go higher and higher without having the drawdowns and drawbacks. But why this is important? This is important because a lot of these people have lack of sufficient historical context and knowledge about the markets. In 2006, the price action of silver mimic identically the 2026 small pullback, small sell-off. The parabolic surge in 2006 of the price of silver led silver to go to $15 per ounce. Everyone was cheating. People were preparing for $100 per ounce. What happened? This price action followed by 40% plunge. 2006. Why this is funny? It's funny because we had 40% crash 2 weeks ago in silver. The problem is that if you again go back to historical context, the silver didn't end up there crashing the price. Silver actually went lower. And the problem was that people have been holding and sitting on losses for 12, 14 years. How are we gonna feel about it? Instead of you making the right decision, instead of you picking or hedging or limiting your risk, you sitting or staying on loss for X amount of years, and you're not only sitting on loss, you are into something known as opportunity cost, meaning instead of you making money of something else or being able to bet on something else, you're locked sitting on your losses, can't do anything about it. Again, people have a very hard time understanding the concepts, and this is why the parallels, because you need to make a parallel between the past and the present, helps you understand and gives you better, not the best, but better chance to what could potentially happen with your portfolio, with your money, and the prices of precious metals, right? If you look at closely, in May 2006, silver skyrocketed 80% from $8.50 amid the, again, retail hype, same people, the usual crowd that is involved in hyping particular asset class. ETF launched SLV. This was another hype that contributed to the bubble. Also, we had some kind of industrial demand narrative that there will be more demand for silver, right? Remember there was like an EV, the beginning of start speaking out loud about electric vehicles and battery, which use a small amount of silver as well for the production. That moment, silver hit $15, just like the 2026 when silver hit 72 and later $121. The problem is that this was a bubble, and the bubbles are bursting. That's what usually happens, and that's what their lifespan looks like. The bubble never stays at the same size. The bubble never remains inflated. The bubble bursts, and a lot of people don't want to hear about this. So look at the parallels, right? We're talking about things that have already happened. Pay very close attention. We're not coming from some, figuratively speaking, Marvel movie scenario. This already happened. So you have nothing to argue, nothing to talk back. This already happened. So open interest in silver exploded, positions turned crowded, and momentum ignored deficit. Exact replica of 2026. We're talking about $3 billion plus ETF inflows, which indicates a lot of people with, let's say, mid-size net worth that use private banking. They call the bankers buy silver, the bankers bought through the ETFs, BlackRock, Vanguard, whatsoever. What happened then? Well, it was painful. The crash mechanics actually were triggered. What happened was that there was a new Fed chair. Oh, surprise, surprise, we do have a new Fed chair coming in May here. The Fed actually changed the interest rates. That back then it was Ben Bernanke who was the Fed chair. What he did is what most likely Kevin Walsh, the incoming Fed chair, will do, which is he will increase the yields on treasuries, which will make it more attractive. People will say, oh, you know what? Instead of holding this, I can hold this, have a risk-free investment, and just chill, right? Get paid even more. So Ben Bernanke increased the yields, which led to the dollar index, which is DXY, exploded. And when dollar explodes, you know what happens with all the leverage position of every asset class that is in contra sentiment with the dollar, gold and silver, trigger massive liquidations. The idea over there that everyone who was long using leverage on gold and silver got liquidated. They lost their entire capital. And then people who were smarter, who used their own funds to buy gold, silver, and gold, they were like, you know what, this thing is not looking good. I'm going to exit and I'm just going to buy treasuries. They look at the market was kind of flickering, didn't quite give a direct signal. You cannot really go directional trade. You don't see, are you going to go the market lower or higher? Let's just go safe. And they went into treasuries. The strategy of the Fed chair worked perfectly. What this actually did to the prices of precious metals, 40% drop in silver overnight, margin call liquidations, people freaked out. That was the end game. Still, there were people hyping, saying, don't worry guys, it will go back up again next week. Next week was 14, 15 years people waited to break even, not to make money. What a bad trade, man. Life is unfair, someone will say. The liquidity evaporated, disappeared. This is why when now I'm explaining to you and I'm showing you the data indicates that there is a very thin liquidity in precious metals, which means it is easy probably to buy in because there's always somebody selling, but it's hard sometimes to get your sell orders go through. Why? Well, you need a matching orders, right? Remember, there is no actual market making that helps you to indicate this. You don't trade this on the exchange. This is essentially a decentralized market similar to Forex, where the Forex works when investment banks work, right? This is why the transactions are different, the spreads are different, the fees are different. On Forex, you as well have to pay an overnight fee for holding the pair of the currency. So you need to understand this is much more complicated than other people think. They just see the surface, they just see the packaging. They don't understand what is inside, and they don't understand how the value of what is inside can go very, very low and can go stay low for a very long period of time. But like I said, people lack historical context because people are lazy. And when people are lazy, you know, it's easier to speak out loud nonsense. It is easier to talk back instead of sitting down. It's weekend, let's open, let's look how much money we invested, let's see what is the forecast, let's see the moving averages, let's see what the analysts are expecting, let's see are institutional investors increased or decreased their current holding, right? Let's create a plan B or C. Let's see if the Fed chair actually repeats what the Ben Bernanke did, what will happen if I lose money, what I'm going to do, when I'm going to cut my losses. So many good questions that people do not really ask themselves, which is the biggest problem over here. Let me tell you about startup idea that is in huge demand but no one is building. It has to be a new social media platform where broke people are not allowed to comment, essentially the haters, right? So it has to be a way, a technology where every user will connect their, net worth, bank account, portfolio. The system will validate that these people actually have credentials to speak on behalf of certain topics, give suggestions what is right or wrong. So broke people will not be allowed to comment, right? This is the huge in-demand social media that will become the future. You no longer will see clueless people speaking from in the middle of nowhere, broke losers commenting, oh no, you're wrong, this or that. They're trying to give, their opinion. No one asks them about their opinion. They're trying to give you their perspective. All of the tech bros watching this build a social media platform where users will have a chance not only to validate their net worth, their credentials, their expertise, their success, and their track record, but also you will limit all the bots. There will be no bots, all the haters, all the broke losers, all the paid shills and people who haven't done a single entrepreneurial venture. Successful or not, entrepreneur is entrepreneur, successful or not, right? Regardless, you take risk, you put your own funds, you hustle. So then you will have the most valuable company in the world, because when the advertisers show up, they know exactly who they're advertising in front of. Okay, this video has 1 million views. All the commenters are sub $300 million net worth. You know exactly what to offer. Imagine what kind of brands will show up trying to run ads on your campaign. So you effectively don't need so many users like YouTube, Facebook, Instagram. You just need to have the high life on your platform. The real rich people. Not the people who are flexing, not the people who are pretending, not the scammers, not the losers, not the bots. So Tech Bros, this is the platform you should build. So when you publish a content as somebody who is expert in their field, and when you sit down and read through the comments, you said, you know what? This person is actually right. He has made, $150 million more than me in this particular business. Let's say I speak about gold and silver, right? And somebody said, you know what? I made, $45 million last week. I'm gonna show you how to do it. I said, fine. Let's see each other. Let's talk about it. Let's have a Zoom talk, right? This is absolutely amazing and most valuable potential social media because every big fish will want to be part of it. No losers will be accepted, no scammers will be accepted, everyone will be vetted, and there will be created a massive value for every participant on each side of the equation. The advertisers, the content creators, and the founders themselves.